Hi everyone, welcome back to the YouTube channel, and in this episode I want to cover what the hell is cash flow. So many people, you talk about assets, liability, profit, revenue, and all of these accounting concepts that, let's face it, nobody is that excited in getting to know. But if you don't understand what cash flow is, it can cost you not just money, your entire business. In fact, not having enough money and understanding what cash flow is one of, if not the number one reason that new startup businesses fail in the first 3 years. So we're going to be breaking down what cash flow is and giving you some of my top tips in making sure you can manage it so you retain and have more money in your pocket to move your business forward. So before we get started, for those that don't know me, my name's Jamie York, and on these videos we are going into 2021 posting 3 times a week covering everything personal finance, investment and property to help you build financial success in your future. And if you're interested in finding out more about that, make sure to hit the subscribe button and the notification bell, and it will help tremendously if you can hit the like button on this for the YouTube algorithm. So let's jump in. Okay, so first of all, there's understanding what cash flow is against other things, because they're not the same, and why it destroys so many businesses. Okay, so first of all, cash flow, profit, they are very different things. You can have a massively profitable business and still go bust, still end the business. And yet if you have good cash flow, even if you're making a loss, you can still maintain the business. So profit is an accounting concept, okay? It's a paperwork exercise rather than real money, which cash flow is. So profit, you can have a building that's worth $500,000. Let's assume you've got no debt whatsoever. And if you've got that building this year, you have made £500,000 profit. Now, is that going to pay your salary? Let's assume it's not got tenants in and all of that. Is it going to pay your staff salary? Is it going to pay your marketing expenses, your insurances? No. Whereas cash flow is a real concept, okay? And what cash flow is simply the flow of cash in your business. And what you're hoping for each month is a net positive cash flow position. For example, 100,000 coming in, 60,000 going out, you have 40,000 pounds worth of net cash flow in a month. And businesses fail all the time because they focus on going, yes, we're making loads of money on paper, but in reality, they're not actually getting it in each month to pay people. So you see these really successful businesses on paper going out of business within the first couple of years. Okay, and a breakdown of this is understanding accounts payable versus accounts receivable. Now, this is where people get really confused. So, well, what the hell does that mean? Essentially, when you're looking at your books, your accounts payable is what are you paying out? So it could be suppliers, could be marketing, could be your staffing. Out of your account each month, what are you paying out of your business? And then on the other side, accounts receivable. What do you do, your product, your service, to attract money into your business? And it is your job as the business owner, whether this is in property, investment, coaching, you could have a furniture store, whatever it is, it's the same thing. Your job is to make sure that the accounts receivable as a book is more money than accounts payable. And if you can do that month on month, this being bigger than this, you are going to have a strong net position moving forward. So this is why business is so bloody hard, especially in the first 6 to 12 months, okay? Now, when you're in a situation, so I'm in my 9th, going into my 10th year of business now, and it's still bloody difficult, by the way. I'm constantly have to manage in books. We're at about 40,000 a month costs. Very quickly next year, I can see that going up to £75,000 a month, and that's scary for me. It is scary. But the difference now is we've got the ability to make cash relatively quickly. So if I needed another 100,000, I feel pretty confident if it was a life or death, I can go and make that next week and be able to pay quite a lot of stuff out for that. So that's the great position. In your first 6 months especially, you are learning new concepts. So even if you're doing the exact same stuff as me right now, you don't have the contacts that I've got. You haven't honed your skill, your pitch that you're moving forward. You haven't got the marketing set up. You haven't got the name in your area, and that takes years to develop. So you're really going out there, you're hustling, you're grinding, you're putting in the time, you're putting in the hours. But the first 6 months, there's a lot of money going out of a business and not a lot coming in. So say, for example, you have something that you sign a contract today. It can be 6 months before you get paid. So for example, in deal trading and deal packaging, which is one of my businesses, if I agree a property today with a vendor, I then sell it to an investor within usually a week. And then I've got an 8 to 12 week period of it going through legals, and then I will get paid. So we're probably talking about 3 to 4 months of something that happens today before I get money. Okay, now that's fine in my business because now I've built up money and things like that. And I'm going to give you some tips around that in a moment. But in your first 6 months of business, even if you close money today, you need to have that lead time for money coming in. Okay, so a piece of advice I'd give around that, which is not on my top tips, is if you're starting out on business, work out what your first 6 to 12 months are going to look like and see if you can get some form of credit, a line of credit, to allow you that 6 months grace period to really give this a go, because ultimately that money in your bank is your oxygen. Okay, and that oxygen to breathe and do what you need to do on a daily basis without looking at your account every 5 minutes. And then I would have it in my head to measure expectations that there's not going to be income for the first 6 months. Okay, now imagine trying to go to the gym without oxygen. Imagine trying to eat your food without oxygen. Imagine trying to go to bed without oxygen. That's what money is to your business. If you can't think, if you can't have the creative space to add value to your clients and have that exchange of service or product for the money they're paying you, then you failed before you've even started. So do yourself a favor, prepare for that lack of oxygen by having that tank along with you. Okay, and that's what you need to have this mindset of moving forward. So you might be thinking at this point, it's all doom and gloom, but it's really not, okay? So you might have heard, you know, if you fail to prepare, you're preparing to fail. And ultimately, this is hoping for the best, but preparing for the worst. And if you can protect your downside and expect all of those delays that I've just gone through, then really everything at worst is as expected. And if not, and money starts coming in, then you really start to fly. Now, here's the practical steps that you can implement to make sure you're going out there with a fighting chance. And ultimately, what I want from this advice is to accelerate and increase your chances of success. So write these down, grab a pen and paper. If you need to pause this whilst you do that, great. But if not, let's jump straight in. So my 5 top tips to make sure you are mastering cash flow in your business, even if you're at the start and even if you're 5 years in, this applies to you. So first of all, control your inventory. Okay, what I mean by that is if you're a service provider, it's a little bit easier, okay? So if you're a coach, a trainer or something like that, really what's your inventory look like? Well, it might be ink, it might be printing, all of those sort of things. But even with that, if you are providing any form of books or something like that, you want to make sure you're not having large storage, okay? It just costs, it's taking up rental space, all of those sort of things. But especially if you're a product-based supplier, okay? And if you are in furniture, if you're in any sort of product, if you're selling things on Amazon, if you're FBA or anything like that, you're doing fulfillment, what I would look at is how you can reduce your inventory overall, okay? Because ultimately it's not just the cost of the stock, which is a cash flow issue, it's also the storage of the stock, making sure it's safe, the security, the insurance, the rent of the space that you're having to pay around it. And something I would look into is JIT, J-I-T, it's just-in-time production. Okay, this is something that came into play about 10 years ago. But what it is you can have this function where people click an order and then the supply chain starts in the background. Sure, it's going to delay things by a few days, maybe even a week. But what this just-in-time production does is dramatically reduce your upfront costs, your ongoing costs, and ultimately, if you wanted that saving, you could pass on to your customer so that you're eliminating your cash flow issues, but also being competitively priced and realizing your unique selling point or your USP in the market. Number 2 is collect receivables. Remember I said the difference between payables and receivables, and the receivables is the money coming in. And this is that profit is an accounting issue rather than a real issue, I can be owed £250,000 contracted by people, and on my books that would mean I have profit of £250,000. But if it ain't in the bank, it ain't paying the bills, right? So what you can do to manage that is make sure you have a process of following up to get the money in, a debt collection if people are missing payments. And also what I find is really good is if you have longer payment terms, if you work with blue chips, for example, bigger companies, you might have payment terms of 6 months to 12 months to 18 months in some cases. So what I like doing with those type of businesses is factoring in a little bit of interest if they are 12 months, but I also like to financially encourage and incentivize those businesses to pay you a bit earlier. So for example, it might be, say you've got £100, but if it's 12 months, you're going to charge £105, so a 5% increase. I might say to somebody, hey, I'll tell you what, if you pay within 60 days, we'll chuck 5% off. Okay, now you're going to take a bit of hit. Let's say you got a £100,000 order. I'll take 95 grand, but only if you pay within a 60-day or a 30-day term. That's going to really incentivize those businesses, because if they can negotiate across the board, that's pure profit for them. And yes, it's taken a bit of a hit for you, but a bird in the hand is better than two in the bush. Right? And it's much better to have money in your bank that you can have working for you rather than you working harder and waiting for your money coming in. And the more you can reduce those, they're called debtor days, the more you can reduce those and get your receivables actually in and received, the better you're going to be able to manage your cash flow, the more likely your business is to be a success. Number 3, and you might have heard me talk about this before, is buffer systems, okay? I'm a massive believer in this. They are the crux, the bane of my life right now. And we've just had 4 days of strategy meetings, myself and my business partner, Dan, where we were talking about building our buffer up to £1 million. And there's part of that that really excites me. There's also part of it, it's just like, oh, having £1 million literally sat there doing nothing. But ultimately, having 6 months worth of money, we have a 6 and 2. So we have 6 months worth of money, costs, salaries, marketing, everything we'd want to do to carry on. And then 2 months trading. So 2 months again in a separate account. And we're looking to build that up to $1 million in the next 2 years, which is a bit depressing, but what it does is it gives me that oxygen, okay? So if I want to take a risk, if I want to push for something, if I want to be creative, if my team comes to me with an idea that's a bit risky, but if it pays off, it's going to make a hell of a lot of money, add a load of value to me, my team, and my customers, I want to be able to go, you know what, let's do this. And if it doesn't work out and it costs me 30 grand, that's okay. We've got the money there to protect against that. And that's what building a business is, okay? So get your buffer systems in place, get your oxygen in place. And the more oxygen you have, the more space you have for creativity, the ability to go out with that value first mindset and worry about profit down the line. And I promise you, if you can go out there not worrying about money, that comes across in your pitch. It comes across in your delivery. It comes across in your creativity. And it comes across in the value that you're able to put out there in the market, which allows you to dominate your space. Okay, number 4 of 5 of the big tips is Paretos Law, or the 80-20 principle. So what this is, and it shows up in all areas of life, but 80% of something happens to 20% of something else. Okay, so 80% of balding happens on 20% of your head. 80% of your money comes from 20% of your customers. 80% of your problems come from 20% of your customers. 80% of your debt comes from 20% of customers. 80% of your staffing problems come from 20% of the staff. All of those things. And actually, you realize this as you build a business, and actually, because of the amount of money you're making, it becomes easier to be logical about the decisions you're making. But actually, if you're at that first stage where you're making, let's say 50 grand for your first year, or even your first 10 grand, you hold on to people that are, and I'm not saying this lightly, cancerous to your life. Okay, cancerous in your friendship groups, to your business, to your growth, to your mindset, to being a better human. And as with cancer, the best thing you can do is cut it out. Okay, and this Pareto's principle is you should strategically, and I mean on a monthly basis, look at all of those areas of your life and go, where are 80% of my problems coming from? With relation to cash flow, because I want to focus on that, not go too deep into that, 80% of the people that the money is owed to you is coming from 20% of your customers. Near guarantee it. 80% of your big money is coming from 20% of your customers. 80% of your tiny money is coming from 20% of your customers. And so what you should regularly do is cut out those customers and offer them an opportunity and say, look, I don't want to work with you anymore, and here's why. So I'm not saying I'm not going to work with you, but if you want to work with me moving forward, this is the guidelines. These are the processes that we're going to work towards. Most of them will go, screw you. At which point, cool, screw them, move on. Okay, and what that allows you to do is, yes, you will take a slight dip in your money, but it will allow you to add more value to the people that clearly value you more, make your life easier and pay you more. What it also does is it allows you that gap of time to go and find better customers in the first place, okay? So apply the 80-20 principle, the Paretos Law, get rid of the 20% that are causing 80% of the issues, and then double down on the 80% and making sure that 100%, and you're constantly fighting against this concept, by the way, and you want to have a full docket of amazing customers rather than balancing your time and spending 80% of your time on the pain in the asses that are causing all these issues in the first place. Number 5, and this is the biggest one, and by the way, this is why I said this isn't just for startups, this is also for scale-ups and people that have been in business for years, is have a cash flow forecast. Okay, a cash flow forecast, it's an accounting document, it's so simple, and it essentially allows you to predict the future. So I know there's 2 months in my business where I know I'm going to make a loss. It's every year we try to fight against it, and we incorporate other parts of different businesses, so it's then in a profit, but it's just the cyclical nature of some of my businesses. But because I know that's going to happen every year, I prepare for it by adding a bit to the buffer to allow for it to come out every single year. The only reason I know that is I have the last 5 years of cash flow forecast, and it's a really simple document. In fact, I'm going to put a link below. There's a company called Score. It's aimed at the American market, but it's absolutely brilliant. So I'm going to put the link below. It's a free download. I'm not getting anything from it. There's no affiliation here. Free download for you to manage. There is no excuse whatsoever. You must have a cash flow forecast, and not only that, you set it up for the year, but you must review it at least once a quarter, because things change, especially right now in 2020 when we've got what's going on in the world right now impacting us. You want to be able to predict as much as possible, so the things that actually come up should be problems in the moment, not things that you could have controlled up front. So just to scale through those again, so you've got my top 5. Number 1, control your inventory. Number 2, collect your receivables. Don't always have them as receivables, have them as accounts received. Number 3 is get your buffer system in place, and I recommend, if that's the first time you've heard that, check out my JARS video. Alex will put a link below for that as well. Number 4 is Paretos Law, the 80-20 principle. Learn to master it and fight against it. And number 5, and again we're putting the link below for this, get your cash flow forecast in place. So I know that's a bit of a weird video, but I really hope that helps you understand what cash flow is against profit and the other accounting terms you might have heard, how you can manage it, the risks involved with it, and how you can mitigate against the circumstances of cash flow, so that if your business does fail, it's nothing to do with not having enough money, it's nothing to do with running out of cash. And hopefully by having this set up in the right way, you've now got the oxygen in place so you can plan ahead and have a successful business. So if you like this video, please make sure to hit the like and leave a comment below to let me know what you think. It really does help the growth of this channel, so I'd really appreciate that. And if you're interested in finding out more about property investment, mindset, and personal finances, make sure to hit the subscribe and the notification bell, and I'll see you on Monday for our next video.